You had mentioned that Quebec was kind of the first kind of jurisdiction to modify that, maybe doing business and kind of create that two-prong test. Do you find, are they kind of like a leader in tax policy, or is there one kind of province or territory that tends to kind of be an outlier from from a tax policy perspective that kind of will pave the way, right? In the States, we often find that, our largest states, California, Texas, New York, Illinois, kind of
They lead the charge.
they try to do some things first.
Yeah.
Yeah.
And then
some
other states
will
will kind of fall in line depending upon what those states decide to do. Yeah.
Yeah, I would say, again, now that we've got many of our provinces harmonized into the federal system, there's only 4 provinces that have sales taxes
that have the option to do so.
So Quebec, for a whole lot of reasons, has always kind of marched to the beat of a different drum. Quebec is a French language province. They follow the civil law, not the common law. So Quebec is a very unique and distinct province within the nation. So they have always approached things a little differently. And I think traditionally it would probably be fair to say that most tax practitioners in Canada would recognize that Quebec has always kind of approached things a little differently, perhaps a little more aggressively, whether it's from their creation of new tax rules or from their audit and administrative perspectives. British Columbia is also a sizable province that kind of leads the charge on a number of instances. So I do think when Quebec, the interesting story or the interesting sort of aspect was when Quebec first announced this Netflix tax. If you really think about what they said, they were saying, hey, we're going to ask these large multinational or large international companies to register for tax in our little jurisdiction of Quebec in the grand scheme of things. And we're going to ask them to charge our Quebec sales tax, which happens to be, like, everything about Quebec is slightly different. Quebec's sales tax rate is 9.975%. Like they don't even have like a 10% or a 7%. They have a 9.975% rate. Anyway, they create this legislation. They say, hey, we're going to expect all these multinationals to register and collect the tax when appropriate. I think in the background, a number of people questioned whether that would really happen, whether compliance would be a viable option or a realistic option. And what in fact happened was, it appears for all intents and purposes that there was a lot of compliance. So I think, frankly, you probably had a number of organizations where senior financial leadership, CFOs in big companies said, hey, this province is expecting us to register. Like, let's just register and comply. We're not picking a fight, so to speak, as to whether we should be registered. We'll just register and collect the tax. And one of the other things the province of Quebec did was they actually published that data. So if you go on the Quebec website today, you can see the list of more than 1,000 companies that are registered under this new simplified regime. So that would be the Netflix of the world, the Amazons of the world, the Airbnbs of the world, those sorts of organizations that are making online supplies to consumers in Quebec. So I think that's when the federal government, the feds, took pause and took note and said, wait a minute, Quebec put this law in place, this new set of tax rules in place. I don't know if anyone really expected them to work, and all of a sudden that everybody was registering and they were working. So after Quebec had that in place for a year or two, the federal government created very similar rules for GST, and then the other 3 PST provinces kind of scratched their heads as well and said, well, hey, if those guys are getting some tax dollars out of this, perhaps we should review online sales into our jurisdictions as well.
Sure.
So then if you were to litigate anything from a tax policy perspective, do you kind of sue, right, in each of the jurisdictions? So if they're not part of the GST, HST, or even like the harmonized, provinces, do they have kind of their own governing board or kind of tax authority, or is it all kind of part of the federal? Like, how does that kind of
so
tax policy creation work and like the litigation work within Canada?
Yeah, so in Canada, if you had an issue with the goods and services tax, the GST, HST. Typically, your issue would be with the Canada Revenue Agency, the tax authority that administers the tax. If there's an audit that goes sideways or audit results that you don't like, those issues all get heard before the Tax Court of Canada. So there is a separate national tax court that hears matters related to the GST, HST, the Canadian income tax. If you don't like the decision of the Tax Court of Canada, you can appeal that to the Federal Appellate Court, the Federal Court of Appeal. And if you don't like the Federal Court of Appeal's decision, you can appeal those decisions to the Supreme Court of Canada. I had a quick look this morning just to see, and there's currently nothing that's being considered to be heard by the Supreme Court of Canada. So, there will be a handful of cases every year that leave is filed to be heard by the Supreme Court of Canada. They typically don't hear tax court cases, but they occasionally will. So that's for the federal GST, HST. If you've got an issue that relates to one of the provincial sales taxes or the jurisdiction of those provinces to enforce those tax regimes, those would typically be heard in the provincial tax court, in the provincial courts of that relevant jurisdiction.
So then there might not be anything in the Canadian Supreme Court, but are there any kind of tax cases out there in Canada, or maybe recent rulings that could be of interest to our listeners?
Yeah, for sure. So there are many tax court cases at sort of the tax court level. So that sort of court of first instance. So there are lots of taxpayers who've appealed their tax audit results to the tax court. A small fraction of those get appealed to the appellate court. Over the last couple of years, the files that end up at the Court of Appeal that are, some of them end up there and they're very narrowly focused, and I don't know that they add a ton of value to most taxpayers' tax positions. The cases that I've followed as of late are typically cases, a number of them involved Canadian banks, Canadian banks who had like loyalty programs, or they might be, this sounds completely different, but follow me for a minute. They might involve professional services like dentists who perform typically exempt dental services, but also sell taxable dental equipment. So there have been a number of tax court cases that have gone up through to the Federal Court of Appeal that are really sort of focused on trying to answer for taxpayers. How do you sort of slice and dice your business to understand what you're really doing? How do you understand what supplies you're truly making to figure out, are you supposed to be charging tax or not charging tax? And if you charge tax, you obviously get to claim tax credits. So there are a number of tax court cases that have kind of looked at this whole concept of when are you making single supplies versus multiple supplies of different things. And a lot of it is driven by people's desire to claim their input tax credits, so to recover the HST they've paid. So those are the kind of cases that kind of end up at the tax court that I think are probably relevant to most businesses. So if you had, businesses that are, if you had clients that were involved in some taxable and some non-taxable activities, those sorts of, the concepts coming out of those tax cases can be pretty relevant to most folks. Other than that, there are a number of court cases in Canada from a GST, HST perspective that are grappling a little bit with residential real property. So, the GST legislation was created, like I said, came into effect in 1990. And I think it's fair to oversimplify the world and say back in the day, it really used real estate. If you were putting it into a business use, you used it one of two ways, right? You rented hotel rooms by the night or you rented apartments by the month. And the GST legislation worked fine with those two frameworks. Now that we have things like Airbnb, where you might have your own personal use property that you make, short-term rentals of, or you might have a property that's short-term rentals for 2 or 3 months of the year and long-term rentals for 9 months of the year. The Canadian GST legislation doesn't really apply easily to those sets of facts. So there are a number of court cases that have come out lately that have tried to help people understand how the change in use rules apply for real estate. So the real takeaway and the questions I often get asked by either Airbnb property owners or people that own these sort of unique hostel hotel type businesses where they're renting some short and some long term is the GST rules for those organizations are actually really quite complex. And it's complex to figure out, do I have to charge tax on the stays? But it's also complex to figure out, do I have a tax liability? Do I have a building that's changed its use and I now have a deemed sale to myself where I have to report tax to the government? So there are lots of weird and wonderful things that are happening in the short-term Airbnb type world, and they are generating a lot of tax court decisions as well.
So from a remediation standpoint, right? So if there was some taxpayers, maybe they're selling into Canada and they should have registered years ago.
Yep.
What are some of the options that they have?
Yeah. So, I mean, the biggest option in Canada is, so anytime I've talked to taxpayers, the first thing I always remind them is, look, you may have a liability. You may not have a liability. We probably need to think a little bit about that carrying on business test. But if we get past that for a minute, there are voluntary disclosure programs in Canada. Obviously, like I said, there's 5 different jurisdictions and they all have their own voluntary disclosure programs. The rules for the voluntary disclosure programs have changed over time, but there are disclosure programs depending on the nature of the error and how old the error is and who your customers are. Each situation is approached a little differently, but in general, it is fair to say most Canadian jurisdictions, if you're doing a voluntary disclosure, will expect you to calculate the tax you didn't collect it and remit it. With the provincial sales taxes, sometimes there are provincial purchase exemption certificates that could have been issued to avoid the requirement to collect the tax. For GST, HST, the tax generally has to be collected, but with any luck, if your clients or customers, if the customers of your clients are involved in a commercial activity, oftentimes they don't even mind paying the GST, even if it's a couple of years late, because they will recover it as well. So there is an exercise in sort of tax churn, I'll call it, like collecting the tax. You can send it in so that your customers can claim it back. But there are voluntary disclosure regimes across the country for dealing with sort of errors and taxes that have been mishandled in the past.
Sure. And then is a typical look back like 3 years, 5 years? Does it depend?
It somewhat depends. The Canada Revenue Agency would note that the Excise Tax Act does give the CRA sort of a wide range of tools to look back pretty far, especially if you have never registered for the GST. So typically our audit window is a 4-year audit window, but it starts from the minute you filed your return.
Sure. Right.
If you never filed your return
Right.
because you weren't registered, then the 4-year clock doesn't necessarily start. Having said that, because there is a 4-year window, there are instances when the voluntary disclosure folks may think it's appropriate to look at 4 years worth of data versus 10 or 15 years worth of data. It's all sort of issue specific and fact driven, and may depend in some instances on who your customers are as well.
Right. Like if they get caught, it's like, well, I can go back, to 1990,
Yes.
right? When I had the
Yeah.
ability to do so. But if you come forward, we'll only go back, forward. That's kind of, I think, standard. When you get caught in the States, often they'll go back 8 to 10 years, if you had Nexus, but then you got to prove Nexus and blah, blah, blah. But then under the voluntary disclosure program, it's typically 3 to 4 and often mirrors the state statute of limitation on assessment.
Yep. And
So-
we run into different tax jurisdictions within Canada have different statutes of limitations. So some of them look at 4 years, some of them, Manitoba in particular, is focused on 6 years. I will say that one of the things we've seen in Canada, sort of post-COVID, um, our government's still probably looking for dollars everywhere it can, and tax rules have changed, but tax administration rules have changed, and the Canadian Tax Authority's been given a number of additional audit tools, and they've been given a number of additional financial resources to hire more auditors. Now, some of that's rolling back a little bit now, but there are more auditors with more tools. So yeah, it's been challenging to ensure compliance.
So what would you, and maybe this is probably just the idea of like doing business in Canada, but what are some of the most common Canadian tax issues you see kind of trip up businesses?
Yeah, so there's probably 2 or 3 really common sort of issues. So the number one issue, and this one happens even to businesses. So Canada's very geographically large. So the first issue happens not only for international businesses, but Canadian businesses as well. It's am I required to be registered for all of these taxes, some of these taxes, none of these taxes, right? So you can have a business located in, Halifax, Nova Scotia, which is thousands of miles from the other coast. And you have questions of, okay, do I need to be registered for British Columbia's provincial sales tax? So one of the biggest things I often run into is businesses, whether they're inside of Canada or outside of Canada, have simply failed to appreciate that they needed to be registered. So that's the number one issue. The number two issue is probably, even when I'm registered, understanding how the place of supply rules work to figure out what rate of tax to charge. So again, if we go back to the federal tax, I mentioned the federal tax, the GST. A number of provinces have harmonized their provincial taxes to create the HST, but that essentially means that this one tax, the GST HST, applies coast to coast, but today it applies at 3 different rates. So it applies at 13% in the province of Ontario. It applies at 15% in the Atlantic Canadian provinces, which are Nova Scotia, New Brunswick, Prince Edward Island, and Newfoundland. And then it applies at 5% in the remainder of the country. So lots of folks fail to appreciate how the place of supply rules work when they're trying to figure out what rate of tax do I apply. So as a quick statement, if you're talking about goods sold in Canada, you're typically looking at the place where the goods were delivered or made available to the customer. So, if I buy something and have it shipped to my address in Nova Scotia, I should expect to pay 15% HST. Pretty straightforward. If you're talking about the acquisition of a service, services are generally taxed based on the place where the recipient, where the purchaser resides, like what their address is. So again, that way, if a business based in Ontario buys a service from a service provider anywhere in the country, they will still pay HST at 13%. So those are the 2 very general rules, but then there's a whole lot of complex rules for understanding if you're making supplies of intangibles or specified services, how to figure out what rate of tax to apply. So I've seen lots of instances where people just don't get the tax rate right, or they don't understand that, yes, I'm registered for Manitoba PST, but I didn't understand that I had to apply PST on all of these sales that I thought were outside the province.
Yeah, we have that similarly kind of, it's almost, I think of it kind of like my income tax hat sits on when you're thinking about sourcing of services. And it's like, yeah, where's the benefit or where's the customer? And there's a cascading rule of like, well, if for nothing else, the billing address is what resides. But if it's infrastructure as a service, is it where the server is or is it where the customer is? So it sounds like, maybe if it's not per se from an income tax perspective, but maybe it is, but realistically that services and that sourcing of location of delivery, receipt, whatever, right? It's never just as simple as blah, right? Where the purchaser resides.
Yeah,
Well, what does that
exactly.
mean?
Yeah. Or the purchaser has 7 addresses in 3 different provinces or states, and which one is the relevant address. Yeah. The other thing, I guess, and maybe this would be interesting too for some of your listeners, if you are registered for Canadian GST, I did mention earlier you do get to claim input tax credits, so you get to claim credits for the GST or HST you've previously paid. Conceptually, that's a simple statement. There are documentary requirements. So to claim the GST that you've paid in the past, you do need to have documentation to support your claim. So the documents need to include things like the vendor's name, the vendor's GST number, description of what's been sold to you, the date that it was sold to you. So there are a bunch of documentary requirements that have to be met. And the Canada Revenue Agency does have sort of a process for, quickly identifying and auditing businesses who've made refund claims to ensure that their documentation is in order. So that is one of the things I do kind of talk to a lot of my clients about, is ensuring documentation meets those documentary requirements. In particular, if you're talking about a client who might be a group of companies, so they might have 3 or 4 operating companies, and you've got documentation that's all issued in the name of one of them, and then input tax credits are claimed across the group in all companies, you could actually be at a risk for losing your input tax credits in that scenario. So that's a big issue that it sounds like a simple one. Like, it sounds like it should be straightforward to claim your input tax credits. But it is important to make sure you meet the documentary requirements and to maintain the documentation for audit purposes.
Is there, from a collection standpoint, kind of the concept of like a multiple points of use, where if you're billing a customer, but you know that the kind of purchaser resides in, Quebec and BC and, maybe an HST jurisdiction, that you bifurcate that? Like if you're a seller and you're registered in all of those jurisdictions, to kind of allocate to where those users are? Or is that, you know,
Yeah, I would say less so from a GST HST perspective. So for the federal tax, it's more so a scenario of, okay, we make a supply in Canada, we'll look at the place of supply rules and determine one instance of, one rate of tax to apply to the transaction. But I do think if you've got a scenario where you've got a supplier, vendor selling to a customer and perhaps delivering to a number of provinces, they may have to think about that from a PST perspective.
Mhm.
And again, the PST is oftentimes unrecoverable. So you want to really make sure as a purchaser, if you're paying provincial sales tax, that you're only paying it on the amounts that you should be paying it on, because like I said, it is unrecoverable. So vendors have a responsibility to figure it out, and purchasers are probably pretty observant on the invoices coming in the door to make sure they're not paying double or triple provincial sales tax needlessly.
Right. Well, and I think as we wrap up, is there anything that you can think of that maybe we haven't talked about that would be useful or beneficial to our audience members, kind of regarding what you're doing in our friendly neighbor to the north?
Yeah. So sort of a few things we haven't sort of really touched on, but I thought about would be, so number one would be, um, GST in particular is a fairly business friendly tax, so long as you manage your tax obligations accordingly and proactively. So, for example, if you're a US based business and you're thinking you might sell into Canada, being registered for GST in advance to make sure you can claim all your tax credits and to make sure that you understand what rate of tax to charge your customers. Handling that all on the front end is so much easier for you as a business if you can get that handled on the front end. Um, that would be the big sort of piece of advice I could give my international friends, colleagues, and potential clients. Um, the other thing would be is that Canada over the last few years has been uh, fairly proactive in using tax for public policy purposes. So you do have to be careful in Canada that there isn't a new tax that might be of relevance to you that you didn't hear about before. So over the last 5 years, I would say we've introduced, for example, a luxury vehicles tax. So if you're, buying or selling or importing expensive cars, boats, or planes, there's a new luxury tax that's, quite substantial. The federal government created what we call the underused housing tax. So if there are properties that are being purchased in, cities across Canada by non-residents, and they're not being used at capacity, you may be subject to an underused housing tax by being a property owner in Canada. The goal of that one was, there's in theory a housing crisis in Canada. We don't seem to have enough housing for the number of individuals in our cities. So that was one of the levers the federal government used, was creating this underused housing tax. We've also seen, for the first time ever, over the last couple of months, so between December and February of this year that just passed, there were some tax holidays for certain things purchased in Canada. The big one being GST was removed from meals purchased in restaurants. So it was the first time ever we had a temporary tax holiday for GST, HST purposes. So whether you're a business in Canada making supplies to your customers, or whether you're in Canada paying for things and then claiming tax credits, you do have to be careful, because there does seem to be a lot of appetite in Canada to use tax for policy reasons outside of simply just raising tax dollars. So there is a lot going on in the market around that.
Are there any potential other tax changes that you're following that you think might come down the pike?
The one that's sort of inevitable is there has been an announced GST, HST, like there's a rate change in one of our provinces. So the province I reside in, Nova Scotia, is currently a 15% jurisdiction. It's going to 14%. So I think there's sort of always a discussion in Canada about, or thought at the policy level about how tax is being applied and whether we're competitive internally in the country and externally internationally. So I think there's probably some activity or some thought being put into that. That's kind of what I'm watching for over the next few years. I mean, there's a counterbalance between provinces and the feds needing cash resources and trying to be competitive. So it is a balance, but it seems to be front of mind for a lot of politicians right now.
Okay.
So sounds nothing too dissimilar as what we're dealing with, at the federal level in the States, and then also in the States, and, where Stacey and I live in our local cities that have the authority and autonomy to do whatever they want from a tax policy perspective ish, right? Like our cities in Colorado they can't, increase taxes without a vote of the people. But that's, that's something unique to the Colorado Constitution. So, as much as people may say we're different, like everything you're saying is very much relating to, what we're experiencing in the States, which is why you're a wonderful guest to kind of identify our similarities, build our relationship, and also, just educate the populace on what they're doing. And, $30,000 is sticking out in my mind. That's a third of, our economic nexus threshold.
And
Right.
I should point out too, that's $30,000 Canadian, which at 70 cents on the dollar is probably closer to 24,000 US, something like that. So
Yeah.
I've told almost every potential business client that I run into, I worry less about the $30,000, because typically an American company coming to Canada is coming to Canada for a sizable contract. Like they're not coming here. I mean, I guess some do sales by mail order, but typically organizations are coming here for their multi-$100,000 contract or $1 million contract.
Right.
Like the $30,000 threshold gets blown out of the water pretty quickly. It's usually a question of, are we carrying on business? And if we're not carrying on business, are we meeting those rules for the simplified regime? But yeah, the $30,000 is pretty low, and I don't expect that's changing anytime soon.
Okay.
No, well, and we certainly know who to reach out to if we do hear anything. And so, Jeremy, thank you so much for your time. It was great to have you. We love kind of building that relationship, and so we're happy to know you. So thank you for being here.
No, thank you so much for having me. It was great to join you.
All right.
And
Hey.
this is another episode of Saltivation. Till next time.